G'day and welcome to another episode of Perth Property Insider. I'm your host, Jared Mann, and today I'm excited to have Stuart Wemyss from Pro Solutions Private Clients back for part two of our discussion on how to minimise tax through the three phases of investing. In this part, we get stuck into capital gains tax, one of the biggest costs we can have in taxes. We're going to go through the use of structures, who they're for, who they're not for, benefits, some of the disadvantages, as well as how to find a tax advisor and my personal experiences with accountants and what does holistic accounting actually mean. So got lots to cover. Really looking forward to it. Let's go inside.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management specialists servicing the whole of Perth. Now, here is your host, Jared Mann.
So we get to the end. We're needing to sell one of our properties. The day has come for us to take this cow to market and cash it in. Capital gains tax. What do we need to think about here?
I guess the first comment would be, let's hope you have a massive capital gain.
Well, this is a very good point that you raised, because you would not believe in my sales side of the business. I continually have discussions and people are worried about, if we sell over that's going to mean I have to pay lots of capital gains tax, Jared. And yep. I hear it almost a few times a month. So I know it seems obvious to you and I, but what do you speak to that mindset? What do you say to it?
Well, I mean, if you made a big capital gain, put it differently. If you've got a massive capital gains tax bill, it means that you've kept probably 75% of the actual gain after tax. So either way, the tax man's won, but you've won 3 times as much. So, which is not a reason to ignore it and say, oh, well, it is what it is, who cares? But really, let's put it in perspective. The whole point about owning properties, you get that compounding capital growth, and it can, dollar value wise, it can be some of the best investments you'll ever make. And sure, you've got to pay some tax at the end, but the benefit is you haven't had to pay tax along the way. You've been able to reinvest. Exactly right.
Receiving tax like other instruments such as shares and things.
Yeah, exactly right. So there's some benefits there. So I think firstly put it in perspective. But the second a bit of advice I would have is work out what's the probability of needing to sell a property. Now, of course, we don't know what the future holds, and things can change, and we might need to sell a property that we don't expect that we want to, or in fact, we might decide, it's not performing, or it's a great time to exit the market, whatever it might be.
And I guess this can tie into potentially your plans with your home and how that relates to, what you're going to do and what other money is going to come out of that or needed to upgrade at some point too. Lots of factors that go into that.
There's lots of factors and there's some unknowns as well. So, you can't overthink it, but by the same token, you don't want to give it no thought as well. So I would encourage people to think about what is their strategy. Now, if their strategy is it's likely they're going to need to sell a property or properties, then they want to start thinking or putting a little bit of weight towards minimising capital gains tax. And there might be a few things that they can do or think about. So using a family trust to give them the discretion to distribute that gain across many people or entities. Spreading ownership amongst 2 or more people. So put it in both spouses' names or however that might be. Or a self-managed super fund, which, used to be so common, particularly really from
it was
07
crazy period there.
2015.
Almost everyone was doing it.
Yeah, that's right. But, it can be a really valuable thing. You get it into pension phase and you won't pay any capital gains tax. Well, zero tax, you can't actually get much better than that. And if that's the strategy, maybe it is actually wise then to buy one of those assets inside a self-managed super fund. But you've got to have the context of a strategy to make that decision. Because if you're in a situation where you can build a strategy that doesn't require you to sell any property, well, then you don't disregard capital gains tax, but, I wouldn't be adding a lot of weight to it because, as I said, at the end of the day, if you're paying a lot of tax, you're paying a lot of tax. So Even just looking, if you're able to put it in a discretionary trust, I did some calcs. So if you crystallize a $1 million taxable gain and it was in one person's name, you pay 440 grand of tax. If you're able to actually distribute that $1 million gain across 4 people, you're going to pay $352,000 in tax. So about an $88,000 saving, 20%. Now, you've made $1 million gain, right? So we're talking about $88,000. I don't want to be flagrant. It's a lot of money, but it's probably not life-changing, right? So whether you pay 440 or 350, again, no one wants to pay more. But in this scenario or strategy, that's the taxable amount. So they've made a $2 million gain and they've paid $88,000 more tax. Again, it's not a big deal. It's not a life changer. Something to think about. But if you're paying,
well, I'm glad you mentioned the top number there, because we're talking about a $2 million gain, 50%
discounted,
off because you've held it more than a year, and then paying tax on the $1 million. So that made a bit more sense.
Yeah. So you end up paying 5% more tax just by it all going into one person's name. But as I said, you're still going to end up with more north of $1.5 million of cash in your pocket. So it's like anything, you can't develop a tax strategy to minimize one particular tax, because there's always pros and cons. You might minimize capital gains tax, but it'll come at the cost of income tax or something like that. There's never a magic bullet. It's really about balancing these things out, and then balancing it out from an investment strategy perspective, and then from an asset class perspective as well. So,
and needless to say, with you guys also being holistic and considering finance, that's another big piece to puzzle too. It's no point electing a structure that for that person's situation is going to limit their finance bank options to so few that they're not able to refinance ever, or they're trapped basically with the one lender.
Yep.
So
there's lots of moving parts here, Jared, and tax is only one of them. It is an important one. It's one we all like to focus on, but we must remind ourselves that there are lots of other considerations, and it is only one of those considerations, but an important one.
So we've touched on the use of trusts and structures a bit. We haven't covered accounting at all over the last year. For some of our newer investors who may not have gone into trusts and structures, and even some of the seasoned ones that want to see how this all fits together a bit better, what are some of the uses of trusts and structures and how this fits together? What's some of the benefits of buying in a trust or a company instead of personal names?
The benefit of a trust, a company you would use in some circumstances, as I've spoken about, but they're pretty specific circumstances. So normally it's really personal name or trust or self-managed super fund. They tend to be the sort of common 3 options, and probably trust and personal name are the 2 top most common. So the advantage of putting it into a trust means you have tax flexibility later on, flexibility on how to distribute income, and then flexibility on how to distribute realized capital gains.
So when you say distribute, that basically means, you've got income in the trust from the property being owned in there, and you're deciding just discretionarily where that income goes and whose tax return it shows up on.
Exactly right. You can distribute to different spouses. You could distribute to children or adult children. You could distribute to parents,
other relatives and family.
That's right.
Done in the past,
self-funded retiree parents, those sorts of things. So it gives you that flex, and you can change that from year to year depending on what's going to produce the best tax benefit. Now, as a general rule, people quite often ask, Stuart, should I use a family trust? As a general rule, I would say that if you're PAYG, if you're an employee, you're not self-employed, you should not use a trust. And there's 2 reasons for that. The first one is that any negative gearing, so any losses that the property makes, is trapped inside the trust. You actually can't use it against your personal income. You can carry it forward, so you'll get the eventual use of it, but everyone knows $1 now is better than $1 in 20 years' time. So
depending on your strategy, of course, but going back to the phases, I would suggest someone creates growth in their portfolio first, and then income switches to more income later. Otherwise, they're just not going to have the size of the asset base to get the income that they're going to need. There are those that go out and focus on cash flow properties, and they might have the positive income from day one. But again, that's going to be a very long road to acquire enough cash flow positive properties to hope to replace your income.
That's right. But even if you have a positive cash flow property from a cash perspective, it's not necessarily positive from a taxation perspective, particularly if you've got depreciation, right? So then you've still got, you might have a property that's giving you positive cash flow, but it's creating a tax loss. In that situation, it's still better off to have it in your personal name. True. So there's the negative gearing, and then obviously if you overlay then potentially higher land tax in some states, those two things generally make it less attractive for a PRYG person to use a trust. If you're self-employed and you have business income that you can distribute through a sort of trust structure or even unit trust structure or so forth, then putting a property in a family trust could be a good idea. Now, I wouldn't say it's always a good idea, because then you'd think about the two things I'd think about is land tax and asset protection. So are there any specific asset protection concerns? Because if so, maybe asset protection starts to become more important than tax consequences, and you might then put it in a trust. But if there are no asset protection concerns, then you just have to look at land tax. And then also future income tax flexibility. But if they're self-employed, they're probably going to have a bit of additional flexibility in other areas
in their business structure.
Correct, in their situation. So it's less of a concern. But I mean, a lot of people ask about trusts, and a lot of PAYG people ask about trusts.
And it's a shiny object, isn't it? And, I think a lot of accountants capitalize on the complexity that it creates too, without, speaking too harshly. But that complexity leads to higher ongoing accounting fees, initial setup fees, basically more of the accountant's time to maintain these structures and prepare the financials and submit the tax returns for them. And very often you look at the net gain of all this, and they're actually losing out by setting it up in the first place.
Yeah, that's right. And they could be worse off, like from a taxation perspective or land tax perspective, they could end up being worse off. So, just get some good advice about it and really understand the pros and cons and go into it eyes wide open. I think if you do that, you're probably then going to make the right decision. Whereas just blindly going, I'll put this in a trust, and not really thinking about it carefully and thinking about all those tax elements that we've spoken about, income tax, capital gains, CGT tax, and land tax, without thinking about all those elements, then you risk making a mistake.
And of course, none of this episode has been specific financial or accounting advice. Disclaimer in brackets. So how would someone actually go about finding a tax advisor that's going to give them specific advice for them?
I'd have two bits of advice in regards to that. I would find an investor that has been successful, a property investor, or just an investor generally, I guess, that has been successful.
I think it's important from my perspective anyway, for your accountant and advisors to understand property, because I've seen the outcome of those that really don't like property. And, I often question their motives, especially when financial advice is concerned, and they're not independent, and they're gearing them towards all the products that they can make a commission from, rather than holistic advice that's independent. Sorry to jump in there.
No, not at all. Not at all.
I can speak more strongly sometimes about my preferences, being given that I'm not a financial advisor or accountant.
Yeah, sure. It makes sense though. You never ask your barber whether you need a haircut. Like as Warren Buffett says, if they've got a vested interest, you got to be skeptical about advice, because you're not getting advice. It could often be just a sales spiel rather than advice. So something to be very aware of. I think also, you mentioned, are they investors themselves? It is actually a relevant consideration, because we tend to think very deeply about our own issues and our own challenges and our own tax position and our own financial plans, which is not to say we think deeper about it than our clients, but we think probably more often about it. Yeah. And so if you've got an investor, they're a property investor themselves, or they've been doing developments or whatever it is, that is, your accountant has been doing this, they're likely to have come across all the same issues that you're about to. And so they can, and if not for themselves, then they've done it for other clients. And that experience, and we can all replicate knowledge, very easily, but experience, there's no shortcuts to, right? So if they've been doing it for 20 years, they've learned a lot of things along the way, and they can help guide you to avoid making those common mistakes.
It's the same reason with my property managers we hire, and the vast majority have property investments themselves, definitely their own homes, understand maintenance, understand troubleshooting of things, understand that mindset and the empathy that they can give to the client because they've walked in their shoes. They've had to make the same decisions that they're facing.
There's a really good saying, perhaps it's a bit crude, but I really like it. It's a poor man can't teach another poor man how to be rich. Only a rich man can teach a poor man how to be rich. And it's really, partly mindset, I guess, and then partly the other part is experience. So if you go and find an investor that's been successful, that likes their, not likes their accountant, that feels their accountant has provided value, because that's really the key component or feedback that we get from clients is that they're okay, they complete the tax return, but there's no value add, there's no proactivity, there's nothing like that. So if you can find someone like that, get the referral. I think getting a referral, when you need to find a professional that's going to be in a position to be able to deliver a lot of value to you, referral is the best way to find them. I think, because word of mouth, it just makes sense. And what else are you going to do? Google or something like that? I mean, that's not going to get you there. So that's my first bit of advice: go by referral. And then my second bit of advice is don't judge the service on its price, and that can go both ways, by the way. So I've seen.
Well, you have to look at both sides of the coin, don't you? And people often ask us, what are our fees for property management, or what are my fees for selling? It's only half the equation. It's like, okay, well, what can we do to improve your returns, add value, save you money? Put those two things together, and then you've got the real cost of that service. And unfortunately, some of my last accountants that I've had, and I think it can take a bit of time sometimes to work out what the true cost is of that accountant too. So I've had situations where in moving to the next accountant, they've then asked different questions, looked at things differently, found massive ways for me to save tax, and I can't go back and claim, for all the years that the other accountant didn't pick up on these things. So
as a client in WA said to me recently, you just don't know what good looks like. Right. So you're an accountant and you think it's okay, but you don't really know what good looks like.
Well, it's kind of good when you've had bad experiences.
That makes it a lot
we
easier.
Don't want to go through them. It also helps people choose us for property management. Likewise, when they know what vacancy is, when they know that if their property's been trashed, if someone's placed a tenant in their property that hasn't worked out, and were they really vetted and screened properly? Should they have been in there in the first place? You have a couple of these experiences, and likewise on the tax side, I've had fringe benefit tax handled so poorly from my business that it was a $14,000 bill when it could have been $1,200.
Yep.
I was not distributing to parents-in-law or asked the question to, and it was costing me, $40,000 a year when I had the structures already set up to do so. Couple of examples straight off the top, and you can tell that they are from the deep-seated areas of pain.
But the problem is, Jared, with accounting fees, high fees don't also mean you've got value either, right? Yeah. So I've seen some clients pay some stupidly high fees to their accountant, and the outcome has been poor. Like the advice has been poor. So they've paid twice because they've paid too much tax and they've paid too high a fee. But then the flip side is I've seen clients pay very small fees to their account and get no value. So unfortunately, we kind of, in the absence of any other measure, we tend to use price as a measure of value. And it's not always a good measure of value when it comes to accountants. So I would think that the rock bottom price is probably not going to get you any proactive advice. And really what you want, anyone can produce a tax return. Well, any decent accountant can produce a tax return and do it in a way that's going to keep you out of jail and comply with the laws and et cetera, et cetera. But that's not really what you want. What you really want is a really good accountant can add lots more value than what they subtract in fees. Well, if they're going to, if they've got so tight margins, they're never going to have any time to sit back and think about a particular client. It's never going to get you there. But that doesn't mean you need to go and pay $20,000, $30,000, $40,000, $50,000 a year either, right? So it is a difficult situation because it's not always the more you pay, the more you get. Sometimes it's the more you pay, the less you get, and that's even worse. But don't be afraid to pay, is what I'm trying to say. A fair fee, a fair exchange in value. If the accountant's good and they're going to sit down and really think deeply about your situation, well, they should be fairly rewarded for that. And if you've got a good accountant, whatever they charge in fees, they will deliver far in excess of that amount in value over time. So
the one challenge I've found, and maybe you can speak to this, is when you're starting out your journey, you've got to kind of find an accountant that's further ahead than you. But it's very difficult when you begin and you might not have the financial means or the portfolio and assets built at that time. Accountants, financial planners, they're specialised. They want to add as much value to their clients as well. Their time, the more skilled they are, the higher the cost of their time. So you can't, when you're starting out, often just walk in off the street and get the very best accountant in town. A, you probably couldn't afford them. B, they probably wouldn't accept you as a client because they can't add enough value.
Yep.
And so it's this difficult starting out period. And the same goes for financial advisors. And, we'll get you back and we'll have certainly more topics to discuss next year on the land in that area. But what can you speak to that? Because I found that difficult in my journey. And I get a lot of people that are at that starting out asking me, who should I use as an accountant? Well, I don't have a referral for them myself often.
Yeah, it's a challenge. I used to think, and as a rule of thumb, you should use an accounting firm. If you've got a service business, you should use an accounting firm that's of similar size that your business is. So if you've got 10 staff, go and find a firm that has around 10 staff. Typically, that's a kind of good fit. But if you've got 10 staff, don't go to a big four firm that has 2,000, 4,000, whatever the big four have these days, because you'll end up paying way higher fee and there's just not enough scope to add value. I don't know if that rule of thumb is perfect in every situation, but it's really something to think about. So, if you've got 50 staff and you've got a one-man band, they're probably not going to have the resources to deal with the gamut of issues that a size of a business needs to deal with in that regard. And vice versa.
As you're speaking to now, it does become a bit more, your complexity's up there when you've got the business accounts, your personal accounts, your investing wrapped in there. And these are good points for those that have a business, but what does the individual do?
The individual just needs to find another good individual. And if they grow beyond that, realize that
that's a good point. Don't be afraid to get to a point where you outgrow your accountant. And the relationship doesn't have to be a forever one. It's what you can afford and the best advice that you can get at that time. And you don't go back and kick yourself for getting the best advice is better than no advice. So that's probably a good place to end things on for most people. Yeah,
that's right. And I think you're spot on, Jared. It's about finding the best person for you at that particular time. And that might change over time. So you might end up outgrowing your accountant because you've got a wider gamut or need of services. And that's fine. No big deal. People move around. We all understand that as accountants ourselves. And, it's just about delivering value.
So where do you fit into the overall picture, just as a final thought, if someone who's listening thinks that they like your approach and might want to go further to see if you're a potential fit for working with them?
Well, Jared, we work with clients, help them develop a long-term strategy and then work with them over the years to execute on that strategy. And we like to inspire our clients to adopt a holistic approach. Because
that's been the biggest difference I've found, because I used to be in the middle trying to pull together the finance broker, the accountant, the financial planner, everyone telling me different things. My head's spinning. One doesn't know what the other's thinking, and you don't understand holistic until you have it.
Yeah.
So that's a good plug for you.
Thanks, Jerry. Which is like what that other client said is, You don't know what good looks like. So because so many things are interrelated, particularly with property, you've got tax, you've got financing, you've got financial planning, you've got cash flow, you've got asset protection, insurance. There's a lot of things, and I don't want to overcomplicate it, and I don't mean to overcomplicate it. But by the same token, if you simplify it too much,
have listened to this episode and had their heads spin and thought, geez, this accounting world's a lot more complex than I thought. But you start out, you take action, you don't let paralysis get in the way. But then if you want to go deeper and start optimizing these things, that's where the right accounting can help. But keep going with what you're about, because I just got excited there.
It's okay, no dramas. So we inspire our clients to adopt a holistic approach, which means that we will typically look after everything for them. We will help them develop a long-term strategies, the financial planning piece. We will make sure we've got a financing strategy that underpins that, which is really the borrowing piece, if that's necessary. And then me as a financial planner work hand in hand with our accountants to make sure that we're going to then deliver on value. Because actually it's a really interesting thing. I was having a conversation with a client this week about profit distribution. When you, at the end of the year, what are you going to do with your profit particularly if you're self-employed? On one hand, you want to make good long-term decisions. On the other hand, you need to have the flexibility to make different slight changes or sometimes substantial changes year to year, right? And there's a tension there because you don't want to make really short-term decisions, but also you don't want to ignore the long-term outcomes either. So,
and what you decide to distribute has a direct impact on what you can then borrow, which feeds into your overall wealth creation plan, and
how much you'll be able to reduce debt if that's necessary as well. Like if you've got
these
home
are some
loan
of
debt.
The disconnects when we're taking advice from our accountant versus our finance broker versus.
So a collaborative approach then between financial services professionals, advisors, accountants, and so forth yields then the best answer. And you're only going to get that collaborative approach in the one firm. It would be nice to think that you could just match, different unknown professionals together and get them to collaborate. I guess theoretically it should work, but practically it never does. People have different ways of thinking, do things differently, different relationships with the clients. Other people don't want, don't tell me what to do. That's a tax thing and a financial planner shouldn't get involved, etc. Too many personalities. So it just doesn't work and ends up meaning that the client is the conduit and the meat and the sandwich, if you like, and they don't know enough either to decide what's relevant and not relevant. So, having a collaborative approach on a financial services perspective yields the best outcomes, and that's what we do.
No worries. Wow. Pro Solutions is where you work. You can see details for their website in the show notes. And we nearly wrapped into another episode there of what is holistic advice and how to choose a financial planner /accountant/finance broker. That's good.
That's it.
But thanks for joining us for your episodes in 2021, and have a fabulous Christmas break for you and your family. And I look forward to chatting again in the new year.
Thanks, Jared. It's been a pleasure.